Behind the cloud, the AI data centers, and the expanding power grids lies a massive physical reality composed almost entirely of copper wiring. For decades, copper demand tracked predictably with housing construction and general manufacturing. Now, that curve is decoupling from those traditional cycles and tying itself entirely to the structural, multi-decade expansion of global electrification. This volume comparison chart illustrates the sheer physical mass required for the energy transition. An electric vehicle needs 2 to 4 times the copper of an internal combustion engine, multiplying the material requirements for every unit produced. Guaranteed long-term demand sounds like a perfectly insulated investment thesis, yet commodity markets are famous for brutal, self-destructive capital cycles that swing violently between massive booms and crushing oversupply. Pouring money into an industry with infinite demand expectations is historically one of the fastest ways to wipe out shareholder value if the timing and mechanics of those cycles are misunderstood. This risk exists because copper supply is uniquely inelastic. Look at the immense scale of this open-pit operation. Developing a major asset like this is among the most capital-intensive processes on Earth, and the timeline to actual production routinely stretches past a decade. And that timeline is getting longer. Governments increasingly treat critical minerals as strategic security assets, adding geopolitical friction to the supply chain, while environmental permitting requirements steadily extend the approval process. The geology itself is also becoming stingier. Miners are facing declining ore grades worldwide, forcing them to excavate and process significantly more rock just to yield the exact same volume of usable copper. Processing all that extra material requires massive amounts of power and water. Rising electricity and fuel costs squeeze operational profit margins heavily, even when the market price for the metal remains completely flat. So when demand surges unexpectedly, the market price explodes upward because new supply physically cannot appear fast enough to fill the gap. When those metal prices are elevated, mining companies often report staggering headline operating margins, making the sector look incredibly lucrative. This flowchart models operating leverage. With fixed costs, a modest revenue bump drastically expands the profit block. But sustaining depleting mines requires aggressive capital expenditure, which quickly eats into that margin. The tiny sliver remaining is free cash flow. A producer can easily report record-breaking accounting profits on paper, while simultaneously draining their actual cash reserves to keep their aging infrastructure operational. Near-term pricing faces heavy cyclical threats. China remains a dominant consumer of industrial metals, and weakness in massive property developments creates immediate uncertainty for demand. Let's run a stress test. This balance sheet scale shows Company A with strong cash, while Company B carries heavy leverage. If prices drop, both lose revenue, but Company B's rigid debt obligations flash red, overwhelming the incoming cash. The commodity cycle strictly punishes leverage. Incoming cash flow can evaporate in weeks, but the debt payments remain entirely fixed. During previous upcycles, mining executives repeatedly made a fatal error, treating temporary price spikes as a permanent new reality and racing to expand. When the entire industry funds new projects at the exact same time, they eventually flood the market with oversupply. Prices collapse, leaving balance sheets loaded with unserviceable debt. To avoid this trap, developers rely on long-term incentive prices. The market price of copper needs to remain exceptionally high for long periods to justify the billions of dollars required to break ground on a new site. The industry sits exactly at this crossroads today. Disciplined producers could generate massive returns by steadily feeding electrification demand, provided global manufacturing avoids a severe, prolonged contraction. To predict the direction of the market, analysts track capital expenditure intensity across the sector. If companies suddenly approve massive new expansions simultaneously, future oversupply risks surge. They also monitor global manufacturing data and physical inventory levels. The green economy cannot exist entirely as software or policy. building the physical infrastructure of the future relies heavily on whether the mining sector can maintain enough financial discipline to supply the copper without destroying itself in the process.